When the markets go south, many worry that the global slump is unavoidable. In this upcoming session, experts will weigh in on whether these fears have any merit. Experts will look at the factors behind these uncertainties, what it means for investors, and how to position yourself for maximum returns in such an environment. Please welcome to the stage Mr. Justin Zacks, Vice President of Strategy at Moomoo Technologies Inc., Mr. Thomas Quilty, CEO of BD Consulting and Investigations Inc., Mr. Mark Hilton, CEO of Alpine Gold LLC, and Mr. John Thaler, attorney at Thaler Law Corporation. They will take the discussion forward on reading the market's tea leaves for global slump risks. Thank you.
Good morning, everyone. First thing I'm going to tell you about reading tea leaves is it can't be done. And these gentlemen are going to tell you why in just a moment. The first thing I want to say is that when you're looking at anything global, the number of things that can go wrong or change in your equation is probably monumental. So what we're going to try to do today is, rather than tell you how to read tea leaves so much, we're going to try to explain to you what factors you're looking for that can give you and your clients the best advice and the most sound advice. First, I'm going to turn it over to Tom, who has a couple of things he needs to say.
Hello. Thanks, John. This is, first of all, a little bit about me. I have a consulting and investigative company in Silicon Valley and in Massachusetts. And as my friend Parag Nevatia asked me the other day, it says, just what do you do? And I'm going, well, basically for the past 50 years almost, I solve problems for my clients and the companies, and that describes it. But in regards to this particular subject, I have to disagree with you, John. You know, and I'm sorry about that, but I've got to disagree with you. I have the tea leaves. They are secret tea leaves that will tell me everything I need to know about the future. So I'm going to open them up and take a look. Oh, yeah? What do you think?
Okay. Oh,
yeah.
Thanks for sharing those. Oh, yeah, good to know.
Do you want to see it?
I better.
Yeah. What do you think, Joe?
Quite amazing.
All right, so what do the tea leaves say exactly?
Well, actually, what they say is there's no clue. And in that regard, if you're trying to read tea leaves to the future, this is not the way to go. John?
So we're going to talk a little bit about what do you do? How do you advise your clients, whether you're in business or whether you're in law? You need to be able to talk to them intelligently, but you also need to make sure they understand that which is, for all of us, extremely complicated. I'm going to start off with a couple of quick stories. Then we're going to have the gentleman on stage say a few things about this, and then we're going to go through our idea of what tea leaves really are. At any point, I want to tell you that if you have a question about anything we're asking, don't wait till the end. Please come up to the microphone, because we're going to talk about a number of different subjects. And so we want you all to have the opportunity to get in a question if it's relevant to what we're talking about and not have to wait. The first thing I'll tell you is that most of the time when you're reading tea leaves, we talk about statistics, government data. One of the big things is, labor statistics, especially when we're talking these days about interest rates. We're talking about labor statistics. How many people are working? How many people are not working? How many jobs were created? The GDP, which nobody actually understands except it's this really neat number. And of course, global slump risk, whether or not we're going into a recession. So with that in mind, one of the first things I want to tell you is don't believe government statistics. They're often wrong. And we just had this come up in the last couple of days. During the second quarter of this year, we were told that the government expanded, that the economy grew, and that 1 million jobs were added to the economy. Turns out that was false. Turns out that because of the way the calculations were originally done, they were off. They were off by 990,000. Instead of the economy creating 1 million new jobs, it created 10,000 jobs. So the idea that we weren't in a recession is now gone by the wayside. I think it's fair to say that at least to some degree we are in one. And if you had read those tea leaves and then heard the speeches being made by the Federal Reserve, by the President of the United States afterwards, you would have thought we were in a period of great growth. We were not. So you have to be very careful about the statistics that you look at, how they're gathered, and then how you use them in talking to your clients. They always get revised, usually about 3 or 4 months later when nobody seems to care anymore, and they can have a great effect on what you tell your clients and what their businesses are. Tell you another story. When I was in law school, I had a friend of mine whose family was in the gold business. They were manufacturing jewelry. And you would think this would be a pretty stable business. They were making jewelry in those days for the May Company. The problem was they had bought their supply of gold at about $500 an ounce, only to have a recession take down the value of the gold to $200 an ounce. Not once did they consider that if they now had to sell their product at market value, say gold chains, necklaces, rings, at market value, they were going to take a beating. There's no way they could make up this difference. They wound up going out of business. After 35 years of being in the manufacturing business, they went out of business. And the reason they went out of business is because they didn't know some of the fundamentals they could do to ensure that difference in price. In their case, it was the futures market. As much as we hear about, $100,000 hog belly deals and stuff like that, the fact is that the futures market exists as an insurance policy, so that if your client is investing in things that are on futures trades, where future prices are in order, whether that be their transportation company and there's oil involved, or whether they're manufacturing and there's certain products, there's certain precious metals involved for them, you have to look at the futures market. Had my friends, they weren't even clients yet, had my friends invested in the futures market, bought what we call put options, in other words, betting that the price of gold would go down, they could have put down a very small amount of money, but would have hedged against their losses, but they didn't do that. And so they're out of business. So that's something you can always discuss with your clients. Make sure they know the options, whether it's insurance policies, for example, crop insurance. If your client's a farmer, you have insurance policies that deal with crops, so that if your crops don't come out this year, if something happens, there's a tornado that wipes out your farm, you can still get paid. These are things people don't think about because they're thinking too much about transportation and shipping and how many boats are in Los Angeles. Another thing I would mention, I'll mention this briefly, is a company called Potash. Potash is a company based out of Canada. It's a fertilizer company. Potash is famous for its CEO saying one thing and one thing only. In a discussion that he had with the Wall Street Journal and Barron's, he was asked about what do we do if people aren't going to buy your product? What happens in an economic downturn? And his company, mostly Potash, sells mostly to the Chinese. So he had one word for them. He said, what are they going to do? Eat bark? If you can put your clients into a business, or at least into a subsidiary or part of their business that deals with the problems of inflation or problems of recession or problems with market changes, where that product itself is not going to change, is going to always be needed, then your clients are always going to know they have revenue. And it's not just companies like Potash. When R.J. Reynolds realized that cigarette smoking in the United States was going to severely decline, and certainly maybe even made illegal most places, or certainly made very hard to do, RJR became RJR Nabisco. They bought a food company, so they diversified. Those are the things that you have to be thinking about when you're talking to your clients. It's not simply about, gee, did the price of this go up, or the price of that go down, or is there a pandemic, or can we ship, or can we get a truck, or can we get a railroad line? It's all of these things. What do you do in advance of these things to make your client's business less frightening to them in times of slumps? And with that, I'm going to turn it over, I think, first to Mark for a few words on this subject.
Yeah, thank you, John. So a little by my background, I'm in the precious metals business. So we're focused on offering choice in currency. We focus specifically on legal tender, specie legal tender, which means gold and silver minted by the U.S. government. And so obviously, a lot of the conversations we have with our clients, who are mostly individual investors, folks trying to protect their wealth, is around trying to estimate, what's going to happen in the market, where's the price going to go, is this a good time to buy, those kinds of things. Interestingly, the point that John just brought up is something that comes up a lot, where you might have, we actually have a lease program where people will lease their gold back to us, and then through third parties, we will actually provide leases to companies that whose operations are based on the price of gold. So they don't actually need to take out a complicated futures thing that nobody understands. They just take out a bond in gold, or they take out debt in gold, and if gold and they're a mine, they're a jewelry store, their inventory is based in gold, they don't have to worry about the price going up and down, and they can protect them somehow. So that's one of the methods that we help people do. But our main focus is helping individuals protect their wealth, as well as offering options for folks who are worried about inflation, which we'll talk about here in a moment. But that's a little bit about me. I think Justin was next.
Yeah, Justin.
Yeah, hi, I'm Justin Zacks. I'm the Vice President of Strategy at Moomoo, an online trading app. And part of my job at Moomoo is to help guide our users to the current risks in the economy and further investments. So it's something, that there's trends are shifting all the time, and it's something we'll talk a little bit later about, but this is something that I help our users do on the app.
So before I get to Tom specifically, I wanted to ask both of you. We hear talk of recession, but at the same time, we see prices going up. Now, we know that energy prices recently have gone down. But could you talk a little bit about this kind of marketplace and what you guys can do to affect for clients, a better outcome? I'll start with Justin.
So right now you are seeing prices come down for goods, but I still see services. I mean, if you've been to the airport here in Las Vegas, you saw that there's still a lot of people traveling, and certainly real wages are increasing at a significant rate, despite maybe some nefarious statistics that you mentioned before. So you really have to categorize inflation in different buckets to say, where that inflation is. And depending what type of firm you are, I think that's going to determine, what you're going to need to do about it.
Yeah, I mean, it's a great question. We're all about trying to have sound money. And so what is money versus currency? Money is the store of value. Currency is just a medium of exchange. So you can have a lot of inflation, a lot of or devaluation of the currency through manipulation, through abuse. But when you have something like gold and silver, we call it money, because it doesn't devalue. I mean, over the last 5,000 years, it doesn't. Now it's going to bounce around relative to the dollar because of things that are happening in the global dollar denominated market. But in general, over the medium and long term, it's going to maintain its value. So what we're doing is we're enabling a commerce system to allow people to actually spend gold. Some of you may have seen now the gold-backed booth out here. You can actually have notes that are made of gold, and there's a growing network of merchants that are accepting gold directly. And so this protects people from the ups and downs and the manipulations of the market. And it's a huge growing trend that we're seeing.
Tom, how does a business prepare for a downturn?
This is a big question. When it comes to business, you have to manage your risk of the business. There's a lot of things business can do or to consider. For your risks, you need to take a look at what is your supply chain? How would your supply chain be affected by a downturn? Same thing. You may have customers, but if they're affected by the downturn, they may not be able to afford your goods. And then also your staff, and then regulations.
Could you talk a little bit about assessment risk and when you see when a client comes to you and asks you for an assessment, what do you do? What do you sit down and talk to them about?
Understanding your company. And I beat this drum every time I go. It says, I've probably been to 500 different companies. And when I go there, I'm surprised at how many people don't understand their own company. At the top, yes. But as you go further down the company, less and less people really understand the company. And they don't understand how they impact the overall. And so that's the number one thing I talk to the people about at a company is understanding their company, making sure their employees do, and understanding all the different aspects that could be at risk, especially in a downturn.
Justin, I know we've talked a little bit about money and recessions versus inflation. We have this Federal Reserve, and people really know very little about what it exactly does and why we even have one. But obviously what they've been telling us has been very, very important. And obviously, as everybody has seen on TV the last couple of months, they have the ability to raise or lower interest rates. Could you talk a little bit about the Federal Reserve and what you see them doing in the future and why?
Sure. Right now, basically during the pandemic, Congress passed bills to pump trillions of dollars into the system. And if you asked economists at the beginning of the year, what was going to happen to inflation, they said, well, it'll be below 2%. And we could see how well that prediction turned out. But looking back on it, it's pretty obvious. If you're going to put that much money in the system, it's going to cause inflation. And so now, in reaction, the Fed has had to raise interest rates faster than they've done in 35 years to help dampen that inflation. And like I said, they've done a little bit on the good side and have been able to bring that down, but it's still going at a tremendous clip. And now I would say more than half of economists now are predicting in a recession at some point next year. And they think the Fed's actually at some point going to cut rates later in the half of the year. So if the Fed does what it says and basically raises a few more times and keeps rates steady throughout 2023 to allow their monetary policy to work through the system, there's a good chance that will be even a higher percentage chance of happening to have a recession. So it will be interesting to see, what plays out with the Fed. And the Fed, it's not just the Fed. I mean, this is happening globally. There's about 250 trading days in the year. There's been more central bank cuts across the world this year than we've had trading days. And we just saw the last domino fall a couple days ago in Japan, and they finally raised the cap on their 10-year rates, and they're now going to pursue a more hawkish policy. So it's not just the U.S., it's globally, and certainly something that to be on the lookout for, not just in the U.S., but for any type of global recession risk.
Well, let me ask you a little bit further about that. You talked about this being globally and about different markets and about different central banks. Could you talk a little bit about central banks, especially in Europe, which is, I think, where most people are going to have investments, and certainly, I guess, in Asia as well. You mentioned Japan, and how what they do there affects both our Fed policy, but also how our Fed policy can affect what they do, and then how you advise your clients accordingly.
Yeah, I mean, ultimately, on an investment standpoint, it's all connected. If someone sees that Japanese stocks or Japanese bonds are cheaper than U.S. ones, they're going to go and invest in those types of things. But each situation is unique. So you look at Europe. In Europe, a lot of their inflation is really about Ukraine's invasion of Russia. It's about energy. And so that's a much more transitory type thing. You've talked about that earlier. Oil prices are lower than they were before the invasion. So that part's already come back down. So they're going to have a little bit different way they're going to deal with inflation, but it's still running through there.
And Mark, I would ask you the same question in terms of these kinds of changes, and you have to watch out now, not just for our central bank, not just our Federal Reserve, but for Federal Reserves of other countries. How do you factor that in to what you do, and how do you advise clients accordingly?
Well, we look at the Federal Reserve system in general. I mean, and the analogy that makes sense to me is this sort of second order effect thing. If any of you have had one of these showers that don't respond very quickly to change, you can either get completely burned or frozen to death. And what happens is, I lived in South America, and a lot of the showers were this way. You get in, it's really cold, you go, I better turn that up a little bit. I got to turn a little more. You just keep cranking the dial till you're all the way over. You're still freezing, and then it starts to warm up, and you think, oh, this is good. I'm feeling better. And then it's getting a little warm, a little uncomfortable. Pretty soon you're turning it back the other way, and you're burning to death in the shower. And then so the point is, the Fed attempts to screw around with the economy, which is so complicated that they're going to cause problems. And it's my opinion and the opinion of many people that these recessions are actually caused by central banks trying to optimize around a particular economic outcome. I don't believe they can do it. And it's hubris to think that they can. So, our strategy is really around sound money. That's why we come back to, gold and silver can weather those kinds of storms. And that's why we're attempting to offer these types of alternative solutions, because with the Fed and with fractional reserve banking, which we have embedded into our economic system, we're going to always see ups and downs. And it's just going to happen. And we're the ones actually causing it and making it worse. So that's how we deal with it. People who come to us are just tired of the system and trying to estimate and trying to forecast. And I just want to get into something that I think is going to be safe in the long run and stable. And that's where gold and silver plays a role.
Well, let me ask you a follow-up to that. Now that the pandemic is seemingly over, is there anything else that you see on the horizon that you think is going to be a big deal thing that's going to affect the markets and thus affect the viability of your products?
Well, I think that, the pandemic and the reaction to the pandemic and the attempt to soften the blow of the pandemic has created this massive influx of dollars into the money supply. We've seen a 27% increase in M2 in 2020, which is like higher than what happened in World War II, higher than the 2008. It was a massive influx. And we saw a bull market as a result of that. There was a lot of money that was available. My investments, and probably a lot of yours, did fantastic in 2020, only to turn around and completely disappear the following year, and to start to see this, crazy inflation. So, I think that it's those kind of dynamics that are going to continue. The pandemic was a shock to our system. What's going to be the next shock? It's hard to know. But we are now dealing with the inflation. And it's interesting when you look at gold prices in particular, you would expect gold prices to be shooting up like crazy, and they're not necessarily. They did go up a lot during the pandemic, from like 1,300 to over 2,000. So that was a huge run. Now they're bouncing around about 1,800, and we're seeing this incredible inflation. A lot of that is a function of the amount of dollars that are out in the system, with dollars being the global reserve currency, that there's a demand for dollars in excess of our normal domestic demand. And so if you're measuring the price of gold relative to the dollar, it doesn't look that great. But if you look on the global market, gold is doing very well against the euro, against the yen, all the other major currencies. It's been holding up and actually performing better than all those currencies. But the dollar is at an all-time high in terms of its strength. So you have to kind of look at these things at a global perspective, as you're saying. And again, our solution is get into those areas that are going to be less impacted by these global things. Gold just being one of them. Sometimes energy is something to look at. There's other safer sectors that you can divert your investments into.
Tom, how do you look at the challenges coming up? Again, with the question being the COVID pandemic causing problems that nobody first saw. But now that we've had this, and we know that something that happens, say, in a lab in China can now affect the entire world and affect it for several years, what do you say to your clients about risk? And are there any risks you see? And I'll point you also to, in Ukraine, the issue of whether or not there could be an escalation of the war would certainly be one, certainly nuclear war. But are there other ones you see out there?
Yes, COVID-19 really changed the landscape for a lot of businesses. Employees were working from home. That increased their cyber, as far as their cybersecurity is concerned, it became a really large problem. How do you manage that? And where do you manage it? So if all of your people are working from home, who's managing your servers? I mean, you've got to have someone in place to do this. So COVID-19 really created a big issue for businesses. The smaller businesses had a problem and they couldn't get staff. And as we possibly move into another global slump and regulation, this is going to happen again. And small businesses are going to take the hit. That's going to help them a lot. But regulations are they have some flexibility and have built resiliency into their their supply chain, their customer base, and staffing, that's going to help them a lot. But regulations are the ones that are the unknown, that are going to come out of anything related to a global slump.
And Justin, I'd ask you the same question, but from a slightly different angle. With your clients, are there risks, obviously with the pandemic allegedly past us now, are there other risks that you see out there, including in Europe, the risks of a greater war? And if so, what do you tell your clients, and how do you place them in a position to, I don't want to use the word take advantage of, that sounds a little bit trite here, but at least come out in an effective position?
I really think the clients, helping the clients understand what is changing in the trends. So when you have the high inflation, people want a way to hedge that. So you have to start thinking about, okay, what type of sectors are going to perform well when you have high inflation? Sectors like energy, and it's not a surprise that energy has been the best performing sector in 2022 so far. And they're interested in getting defensive, because when you have these types of situations with high inflation and you have the Fed against you, your risk goes up. That's something you could have a more negative outcome. So you want to say, well, what can I do to get defensive? And that means sectors like consumer staples, utilities. Again, these are the two of the top performing sectors. The other thing people have been thinking about is not just stocks, right? So there was this, the saying, Tina, there is no alternative. And when bonds were negative yielding, that's stocks were the only place to go. And now, you can get a 4% return on T-bills, pretty much risk free. So there's a lot of people are saying, okay, let me take some of my money, park it, because there's going to be better opportunities that come along at some point, maybe not this year, maybe not next year, but at some point they're going to have an opportunity to put that money to work.
Okay, so I'm not an expert, and I don't play one on TV, and I hear the term yield curve all the time, and I hear about negative yield curves, inverse yield curves, and all these other terms. Could you explain a little bit about what they are and what they tell us about the future of the economy?
Yeah, so this is one of the tea leaves that people do read, and sometimes it works, and in fact, most of the time it's worked recently. So generically, when people talk about the yield curve inversion, they're talking about the 2-year treasury yield being higher than the 10-year treasury yield. Basically, people get afraid and they end up buying longer dated treasuries, which pushes the yield down, and the Fed rates.
All right, so let me stop you for a moment there, because
sorry.
No, it was great. I just want to clarify that. So what you mean by that is that the interest rate that's being paid out on the 2-year note exceeds the 10-year note?
Yes, exactly. So basically, when that's happened, basically for all of the last 10 recessions, the curve has inverted. So normally it makes sense, if you're going to lock your money up for longer, you want to be paid more. But in times of economic uncertainty, it basically reverses. And what I would say going forward, what you really want to look at, so that's 2-year to 10-year inversion, but you can basically look at the yield curve anywhere, from 1 day all the way out, to 30 years. And the one thing that I think investors may want to keep an eye on is the current Fed funds rate and how that relates to the 2-year. And that's going to give you an idea of how long a possible recession will last. And right now, a lot of people think, well, we're going to have a very short and shallow recession. But what if that recession turns out to be maybe shallow, but much longer than expected?
All right, so I'm going to go back to Mark on this. In looking at inflation, and we just mentioned the fact that we've had this very high inflation rate, and yet gold didn't make much of a dent as compared to the dollar. Would that be because the dollar is still considered to be the strong haven currency? And is that something worth investing in, or certainly looking at when you're looking at global downturns?
Yeah, there's a theory called the milkshake theory that has been proposed to explain this, where the dollar is getting, excess dollars are getting sucked up by like a milkshake by global markets, because of the fact that the Fed in, the US Fed raised their rates sooner than others did. So for a lot of people, just looking at the domestic market, it makes no sense. He's like, wait a minute, we're printing money like there's no tomorrow. And you would expect inflation, and almost always when inflation goes up, gold goes up in price. Because it's keeping up with its purchasing power. That's what gold does. If you look back 50 years, the time, gold was $35 an ounce. Now it's almost $2,000 an ounce. That's about an 8% annual growth rate in the last 50 years. So you kind of expect that same performance, but there's some weird stuff going on because of this, the role that gold is, that the dollar is currently playing in global markets. And some of it comes down to this yield curve, because you can get fantastic yields on short-term paper, on US dollars. There's a demand for those. There are individuals and countries that have debt based in dollars, and they have to service that debt. And so now they have to go buy dollars. And so there's this big demand, which drives up the international value of dollar relative to other currencies. And gold is then measured against that dollar. So it's at 1.2 was the number that people have been talking about. And 1 is kind of the average. So it's like 20% higher than what it historically is. And so, we kind of feel it in our import export business, where the dollar is, very expensive. That does impact us. But this is how we see it in gold. We measure it from that perspective. But the question you have to ask yourself is it going to last? Is it going to stay that way? Can it stay strong that long? And usually it cannot. So there's probably a point at which the dollar is going to weaken when other central banks sort of catch up with the rates that the Fed is offering. That's going to depress the dollar, and we've already seen this happen a little bit. And then gold is going to go up. So we think it's a good time to buy gold, from that perspective. But again, gold is a good long-term hedge. But there are other sectors that people need to look at as well to position themselves. And it kind of depends if you're a business or you're an individual. We deal a lot with individuals, but we're also a business. So we look at this ourselves. We had to give our employees a 15% increase this last year. And we did that because we wanted to keep up in paper dollars, right? So that's a cost increase for us as a result of this inflation. All the industries are feeling this, and if they're not doing it, then their employees are seeing a reduced real wage, which is going to impact the ability to consume, which is going to lead to a recession. I mean, these things, they're all tied together. But in our case, we normally do good during a recession, right? People tend to flee to safe assets. And so we've seen, our best year this last year with people worried about what's going on in the global economy, but specifically the US economy.
So Tom, in looking at risk assessment, how do you assess political changes, and what ones do you look at as being the most important? Is there any particular region that you see as being more important, or do you look at them, kind of collectively? And then how do you advise clients accordingly?
Political risk is out there, and says we've got the general election coming up in 2 years. I expect that there will be a lot of regulations coming out. You have the Republicans that they've taken control of the House. The question is, is it going to create more division, or is it going to be regulation or create additional regulation for businesses? And for businesses, politics is always there. It's one of the things that's in the backgrounds. It's potentially a risk. I don't think it's as big a risk as some of the others, as such supply chain or war in either Ukraine or China. So if you had to manage a risk and choose what you want to manage, that's where I would be putting my effort. It's just politics is going to happen no matter what. But what we don't know is going to happen is, what's affecting your supply chain or your employees or your ability to retain employees, and also your customers and their ability to actually buy your goods and services.
We have a question.
Sort of piggybacking off of the gold discussion. I guess if you look at a like a personal personal saving, microcosmic view of the person, your own personal wealth and saving for the future versus like what the economy is doing at macro level. Would you say that a good indication of the market would be like the closing of stores, number of retail closings, the reduction of capital assets in major corporations? I mean, what are the indicators we can look to statistically and say, okay, I can see a trend versus, what the market is doing every day? I mean, I don't know if that's telling you what the inverse yield is doing. So yeah, that's my question. Because on a personal level, I'm not really finding a good framework for looking at risk.
I'll tell you a story that I told these gentlemen earlier. When I was in college, one of the big Christmas hot ticket items was the Cabbage Patch doll. You might all remember the Cabbage Patch doll. I have no idea why people bought these. And looking back on it, we all wonder why we did, but people bought these. And the story is on this doll, which was made by a company called Coleco, which is no longer in business. It started coming out about 2-3 weeks before Thanksgiving. And then in those days, you didn't see Christmas decorations in October. The Christmas period really was from the Friday after Thanksgiving until Christmas. So stories started to come out in the news about people wanting these dolls, which created a hype about more people wanting these dolls. And of course, people rushing the stores to get them, and fights were breaking out, and mothers were screaming at other mothers, my child has to have this. No, you can't have this. No, I want this one. It was awful. And the news footage is really hysterical. If you want to see people going hysterical over an ugly doll, this is it. What was most interesting about this is, I was in college. I didn't know any better. So I thought, okay, this is going to be the hot ticket item for this Christmas period. What can I do to make some money off of this? Because it's not going to be to go into the stores, buy a bunch of these dolls and go sell them on the streets, although that might have been not so bad. What I did instead was I actually bought stock in Coleco the Monday before Thanksgiving, and I sold it the Wednesday after Thanksgiving. The stock price went from $19 to $24 during that time. If you go to a mall, just any mall, walk around the mall, see which stores are crowded and which ones are not. It'll tell you an awful lot. It'll tell you, one, if the stores that they're going into are the ones with the heavy discounts, it tells you a lot about the economy and what kind of money people have to spend. If you go over to Ben Bridge and you see a lot of people buying jewelry, that tells you something about the money they have to spend, which is then going to translate into other things they're going to buy. Are they going to buy a new car or a used car? We've had this change recently about the prices of used cars, but most of the time used cars are less than new cars. So it's going to tell you about, are they going to buy new cars? If they're not going to buy new cars, then you're going to see industries such as, auto industries laying off workers. So that's something it can tell you. You can see certainly when you go to a gym, what the hot equipment is. What are they wearing? What shoes are they wearing on their feet? Usually there's a particular brand or brands that are hot in a particular time. That might tell you something. If people are not replacing items, if they're wearing older equipment, not getting newer shoes, that again will tell you something about cash and cash flow. Remember, it's very important to think about this in more of a kind of a global picture, but in the small setting. If I don't make money from my clients, if they don't pay their bills because they're short on cash, that means I don't go out to a restaurant, which means the busboy is going to get fired from his job because he's not needed, which means he's not going to be able to pay his rent. And you have this and so on and so on and so on situation. So like I said, best thing you can do is not so much read all these facts and figures, if it's something that's not comfortable to you, not try to make sense out of labor statistics or anything like that, but watch what people are doing around you. Best thing you can do is observe. It'll tell you almost everything you need to know about an economy.
I would add, you can look at the government retail sales numbers, but the thing to think about there is think about the sales numbers in relation to inflation. It's really about how many units did they sell, not necessarily are their sales going up because inflation went up, or maybe they're not even tracking inflation. And the other thing I would mention in terms of the economy is, when the earnings seasons come around, don't focus as much on earnings. The companies can manipulate the earnings much easier, but focus on the top line revenue because that's much harder to fake. And that in aggregate will give you a really good idea of where the economy is going.
And if you can, try to convert things
into, there's this concept of real versus nominal. Nominal is what you actually measure in the currency. Real is when you take out the inflation. Obviously, it's hard to really say what the inflation is because it's what you feel yourself, right? It's a basket of goods that some government agency came up with. And those things, the CPI tends to, consumer price index tends to get manipulated. But in general, we like to tell people, we can provide, if you invest with us, we can provide you a real return on gold. But gold, and you could say, well, gold is resistant to inflation, therefore that's a real return, real in terms of purchasing power. But if you go to the stock market, you say, well, I'm getting 10% return on my equity that Justin just advised me on. You're basically making zero, right? I mean, if the inflation's 10%, you're just treading water. And so from a company or an individual perspective, you have to think on, am I really getting ahead in terms of purchasing power, or am I falling behind? And this is where inflation tends to muddy the water a little bit.
And just as a follow on to that, as well as having cash in the bank, again, you're losing whatever the inflation rate. And so you've got to be careful not to hold too much cash, but you still need cash on hand, both businesses and individuals.
Another question.
Yes, thank you so much, gentlemen. You all sound very smart, and I have a question. I'm from Ukraine, and we discuss Ukraine. Actually, President Zelensky should be in Washington, D.C. any one of these days. First time he leaves Ukraine since the war started on February 24th. What is your opinion on the potential of Ukraine becoming second Germany or Japan? Because so many countries are planning to, send money to Ukraine, billions of dollars. Do you think Ukraine is capable of becoming a Eastern European miracle after we defeat terrorists from Russia? And what's your opinion on the reality on the ground? Thank you.
I know they're all going to look at me for this one. I'll start by saying this. Ukraine has a lot of problems. The war certainly added to them, but the war wasn't the first one. The idea that Ukraine is a democracy is for the most part not really true. It's really a one-party system. It has been known for the years. We don't say this anymore because of the war, but the fact is that it's an extraordinarily corrupt organization. The bureaucracy there is extraordinarily corrupt. And the idea that all the money being spent and being sent in there is actually going for what it's supposed to be going for is a highly questionable matter. In fact, there's already talk of a lot of government audits by the Government Accounting Office to try to determine how the monies are actually being spent. At the same time, you have a budget proposal that just came out, an omnibus budget program that's about to probably pass in order to avoid a shutdown, that essentially says that we're going to provide another, $45 billion, I think it is, to Ukraine. Coming out of this war, which ultimately will end probably more of a stalemate than in a peace agreement, it's very hard to say that this is going to work for Ukraine at all. They will have a lot of money that's going to be spent on rebuilding. There'll be a lot of Marshall Plan type actions going on to help rebuild the country. Whether or not that can be forced by the United States and maybe some of the EU countries into ensuring that there's a stable Ukraine afterwards, that there's a country that really has multiple parties, it has free and fair elections, very hard to say. And I would say that, given my experiences in political science, probably very unlikely, because the problem is that when the mentality that goes in is one of the corruption, it's very hard to come out on the other side without the corruption. And so I hope that doesn't become the case. But one of the things that's starting to come out now, and you'll hear more about it, and I'm sure in coming months, especially if with the Republicans taking over the House, is this problem of monies being paid to Ukraine that went back into FTX that then were used to fund Democrat campaigns, a few Republicans too, but Democrat campaigns. That's part of the corruption. One of the reasons it is said, it's not necessarily my opinion, but one of the things that is said about this is that a lot of the reasons why so much money has gone into Ukraine is to funnel it through Ukraine back into companies, not just FTX, but other crypto companies and other, dark money players to come back into American politics. If that's true, and we certainly know money went through Ukraine back into FTX. if that's true, that a lot of the monies came back through into politics, regardless if it's Republican or Democrat, it does not bode well for Ukraine. On the other hand, I'll say one last thing about this, and I'll turn over these gentlemen. Ukraine has an opportunity here, and it's a very unique one, which is, like I said, this will come to an end. If you want a prediction, and I'm not real good on these, but if you want a prediction, I would say come next spring, you're going to probably get some level of an end to hostilities, at least some kind of a ceasefire. At that point, the rebuilding will begin. In addition to wanting to join NATO, if Ukraine really wants to ultimately become part of the EU, which I think is really more its ultimate goal, it's going to have to internally deal with this problem. And, one of the things that happens with that, which is part of global risk assessment, is that if Ukraine can do that, if Zelensky can turn this country into a less corrupt, more efficient state, then that will make it harder for Russia in the future to invade. It'll make it easier to defend, and it will make for, a better global marketplace. Ukraine, as you well know, supplies a very significant portion of wheat, especially into the Middle East. It also has other natural resources, including oil, and certainly is a prime location for pipelines to go, from the Baltic across into Europe. So it's got the ability to earn money and by doing so become more stable. I don't think there's a lot of evidence there, though, at this point, that that's what's going to happen.
And just one thing is this, we need Ukraine to be a stable country, and whatever we can do, we're going to try to do that. But as John was talking about, we've got to deal with the corruption angle. But it's not just the Ukraine; it's the instability in the world that's creating a lot of the chaos that we're seeing. Right now, the Philippines recently had an election. They're now basically arming themselves against the Chinese to be able to fight Chinese aggression. Same thing with Vietnam and Brunei and others. You have North Korea is making overtures towards becoming a full nuclear state and being able to dominate the region. So this instability, Ukraine is one of these factors that creates instability around the world. But as some people look at it, they look at instability as a way of gaining an advantage, and they'll profit on the instability. Others, we need the world to be as stable as possible, and that's my thoughts on that.
I mean, just to generalize this, money flows to where profits can be made, and where risk is lower. So it's just like water flowing down a hill. It's going to go to those places where, me as running a multinational company, I'm going to want to put my investment in areas where I know I can get a return. If I see political risk, that becomes less attractive to me. So the return has to overcome that. So I think it's just echoing what's already been said, but it really is up to Ukraine after this is all over. If a government can be put in place that can be proven to the world and to international investors that it's a stable place to invest, then there's a good chance it could. I mean, there's the capacity of the Ukrainian people is enormous, and we would love to see that, but it's going to come down to individual decisions by governments, but mostly by corporations. Do I want to put money into Ukraine or any other country who's gone through something similar?
Yeah, and I would look at the public money that will be coming from other governments is mainly to rebuild, and it's really to Mark's point, it's about getting that private investment. Are you, as an investor or in the U.S. or wherever you are, going to want to invest in Ukraine? And to me, that's about safety and stability. If they are able to join NATO, that would be a big thing. And I think that would maybe tilt the scales where you might see something. But if you look at what's happened in the past, look at Afghanistan, look at Iraq. I mean, those situations, they were rebuilt, but they're not seeing a ton of private investment from the outside. So it hasn't really worked in their favor. I mean, so there are other examples like Germany, after World War II, that took a long time, but, they have become, an economic power.
One last thing, and just with some of the clients that they want to look at, where do we expand? Can we take advantage of opening up a subsidiary in the Ukraine to our advantage? And that's going to be, that stability is going to be key. And so right now, it's not a good idea to do that. Between the cruise missiles and everything else, we don't know what's going to happen.
That's right. Thank you, professors, for your contribution. Very good. But on February 24th, when Russia invaded Ukraine, my first comment was, it's not Russia, it's our own corruption. That's why Russia is here, because everything was ready to be arranged. They were supposed to be walking in Kyiv in 5 days with, but hopefully soon you all will be going to Ukraine and giving speeches and inspiring our people to new future. Thank you.
We hope so too. Thank you for the question.
No, and I'll make one final comment on that because it goes to, global risk and how you analyze it. I think what you said at the end is the most important part. There's always money to be made. There's money to be made in chaos. There's money to be made in order. Nietzsche would love this. The problem is that you have to be able to tell the difference. And you've got an American Congress at this point that is so in love, I think, with the concept of Ukraine. And I think somewhat of stealing what they perceive to be a satellite from Russia, taking over an area that, was kind of declared to be neutral, kind of the Switzerland of the area before. And they see this as a golden opportunity in some ways to really put, the screws, the thumb screws to Putin. The problem is that if you're looking from our point of view of how we're advising clients, if I had a client who came to me tomorrow and said, I want to put a factory in Taiwan, how would I feel about that? What would I tell them? Taiwan obviously is at peace. It's stable at the moment. It's got warships going all around it constantly 24 hours a day and a lot of threats. But what I want my client to go there. You now see, for example, the microchip industry finding ways to get out of Taiwan. They'll still be manufactured there. A lot of companies will still do it. AMD isn't going to leave that. But you're starting to see, as the president, pointed out the other day, you're starting to see microchip companies come back to the United States. He was just in Arizona to tout a new venture. It's going to take about 5 years to get it up and running, but at least chips are going to come back to the United States. And one of the things you saw, of course, with the pandemic was this very problem of how dependent are we on raw materials, source materials, et cetera. I think part of what you said is correct, that the reason why you had this invasion was specifically because of the chaos that was going on in Ukraine. If it had been a more stable place, this wouldn't have happened. But on the other side of it, I would say that it also starts with raw materials. And what you now have is a grab of countries coming in, especially in Brazil. This has been a big problem. The Chinese coming into Brazil, coming into Africa, taking raw materials. So the stability is still in question if you have lots to give. If you got lots going on in your country, you have lots of materials, this is going to be the problem.
Thank you so much, gentlemen, again. Thank you.
Well, let me thank everybody for coming today. Let me thank my panelists, Justin, Mark, Tom. It's greatly appreciated. Thank you so much. And thank you for being such a great audience.
Thank you, everyone.